I want to come back to yield inversions, but we're going to put a pause on it
Okay.
for right now because it's the question on many investors' minds. Is the rally here to stay? We had cooler inflation data. We have a lower volatility index that have only amplified the market's upward trend as of late. But with valuations setting expectations high as earnings season gets underway, how durable is the rally's staying power? Liz, how durable is the rally's staying power?
Well, look, again, anybody who has heard me talk knows that I've been skeptical of this rally all the way up, and it has not felt great to be skeptical all the way up. At this point, you have to look at fundamentals. You have to look at valuations. And yes, I think there are parts of the market that are maybe trading at reasonable levels if we do not see a recession. And that continues to be the looming big question, right? Will we actually see a contraction that hurts those valuations? If you look at just broad valuations on the S&P 500, we are currently above the 5-year, the 10-year, and the 15-year average. So that almost screams overvalued, or at least that some sort of a healthy pullback to get us back in line with even short-term averages might be due. The other thing is, if you look at where valuations are in certain comparisons to the 10-year yield. So when the 10-year yield is usually this high, I mean, the way that the relationship should work, or the way that it usually works, is that as the 10-year yield rises, valuations come down because your discount rate went up and it became more expensive to get capital. That recently has not been the case. That relationship has completely fallen apart and said it doesn't matter anymore. And you've got stock valuations rising as yields were rising. So it doesn't necessarily mean that one or the other has to happen. It doesn't mean that stocks have to come down. But what I would say is that divergences like that, and when relationships like that stop working the way that they normally do in the short term, that doesn't last forever. So you're going to see some of those divergences close, whether that means yields have to come down or stocks have to come down. Something has to happen to get that middle ground a little bit more narrow.
So does it matter anymore? Because some would say, no, it doesn't matter because there's been a breakdown in that relationship.
Right. Yeah. And, I obviously have learned things from textbooks and I've learned things from the CFA program. And there are times that I look back at some of that or I think back on it and say, what am I missing, right? Because all of this tells me that there's still these big warning signs out there. I do think it matters, but not a lot of things that make sense in the long term are going to matter in the short term. And right now, we've got an economy, and things do change over time. I will not be the one to say it's different this time, because I don't generally believe that the economic cycle is ever all that different. But the catalysts change. And the economy that we live in today versus the economy that we lived in 15 to 20 years ago may be a little less interest rate sensitive. So when you're looking at technology stocks that are just generally more expensive than the rest of the market because you're buying growth. Now, they're interest rate sensitive in the sense of what happened in 2022, but this enthusiasm over AI and enthusiasm over just innovation that's going to occur and how much they make up of the economy hasn't seemed to care as much about interest rates. So there are some changes that have happened for sure that have made us less interest rate sensitive. There's also obviously monetary policy that is much different today than it was 15 to 20 years ago. And just this kind of expectation that we will be saved even if something bad goes wrong. And that's not necessarily a wrong expectation. It has happened every single time over recent history.
Let's come back to the yield curve now to zero in on it a little bit more, because one of the folks who's sort of saying this time is different is Jan Hatzius over at Goldman Sachs, who is not necessarily the person you would expect to be saying that. He's the chief economist over there. This morning, the bank is cutting its recession probability for the next 12 months to 20% from 25%, and saying that the yield curve this time isn't necessarily 100% signaling that recession. Now, he gives a lot of different reasons, including talking about the sort of premium that people are paying on debt now versus what they were historically, which gets a little wonky. But what do you make of that sort of thinking that things could be different?
Again, the catalyst is always different. The thing that gets us there is always different. But the way that we move through a cycle, so early, mid, late recession, right? That's basically the big pieces of an economic cycle. You have to reset the business cycle at some point. So some of if we were going to sit down and have a debate, if Jan and I were going to sit down and have a debate, right? I think probably part of it would be that he maybe thinks we're in a different part of the cycle, maybe an earlier part of the cycle. I'm putting words in his mouth, and I don't mean to do that. But if he thinks we're in an earlier part of the cycle, then maybe a recession is not likely in the next 12 months. I tend to think that we're in the later part of the cycle, and the signals, including yield curve inversions, are pretty clear to me that it's late cycle. Now, late cycle can last a very, very long time, right? Late cycle could last a year and a half, it could last 2 years. And in fact, there's no limit, right? That's the thing about the economic cycle, is that we have no idea how long each phase is going to last, including recession. But I do strongly believe that there has to be a reset. And that reset is something that uninverts the yield curve in multiple places. It takes care of inflation in the sense of brings supply and demand back into balance. Now, the Fed has done a lot of that work for us. Right. But there needs to be a restart so that we get back to early cycle behavior. And generally, valuations would come down to a more palatable level before we embark on a new bull market. New bull markets don't typically start from elevated levels. So that's what makes me skeptical of this one.
Interesting. You're not the only person who says there needs to be a reset or is expecting some kind of reset. Although, we are seeing some differing perspective from Jan from Goldman today.